shadow markets beneath the spotlight. They don't ring bells or flash on trading floors. They don't advertise their size or announce their influence. Yet beneath the visible structure of modern finance exists a parallel system, one that moves capital quietly, efficiently, and largely out of sight. To understand why these shadow markets matter, we need to look at how finance adapts when boundaries tighten. As regulations strengthened traditional banking, activity didn't disappear. It relocated. Lending, borrowing, and risk-taking flowed into spaces that looked different, sounded technical, and operated just beyond the brightest regulatory lights. These markets promised flexibility, speed, and innovation, and they delivered. But they also carried consequences few fully understood. Shadow markets are not illegal by nature. They exist because demand exists. Institutions seek returns. Investors seek yield. Borrowers seek access. When conventional channels impose limits, alternatives emerge to fill the gap. Funds operate outside deposit requirements. Financing moves through private agreements. Risk is transferred through instruments that resemble insurance, but behave like speculation. On the surface, everything appears orderly. Beneath it, complexity deepens. This migration reshaped behavior. Capital moved faster, unconstrained by the buffers designed to absorb shock. Leverage increased quietly, often hidden within structures too layered to evaluate easily. Transactions multiplied, linked by contracts that assumed stability without guaranteeing it. The system became efficient in calm periods and dangerously exposed in stress. For years, these markets grew without incident. They absorbed demand traditional banks could not meet. They smoothed liquidity. They offer returns when safer assets paid little. Their success reinforced the belief that risk had been dispersed, not concentrated. The spotlight remained fixed on visible institutions, while the shadows expanded unnoticed. Even regulators acknowledged their presence, but struggled to define their reach. Oversight followed institutions, not functions. Activity that looked like banking, but didn't call itself banking, slipped through gaps in classification. Reporting existed, but coordination did not. The system appeared diversified, while quietly becoming more interconnected. For the public, shadow markets were invisible. Savings grew. Credit remained available. Stability seemed intact. Few questioned where liquidity truly came from, or how deeply markets were linked beneath the surface. Confidence rested on outcomes, not understanding. These early conditions created a delicate balance. Shadow markets added flexibility, but removed friction. They extended opportunity, but diluted accountability. And while they remained hidden, they reshaped the system in ways that would only become clear when stress arrived. Because when markets operate in the shadows, the danger is not that they exist, but that their scale is only revealed when the lights suddenly turn on. As shadow markets expanded, their influence spread quietly through the financial system. What began as alternatives to traditional banking evolved into essential sources of liquidity. Money market funds, private lenders, and complex funding arrangements stepped in where banks stepped back. In calm conditions, the system appeared efficient. Capital flowed smoothly, and credit remained accessible without triggering regulatory alarms. But this efficiency masked a deeper vulnerability. Shadow markets relied on confidence without guarantees. Unlike banks, they did not hold deposits protected by safety nets. Their funding was short-term, often renewable daily, and depended on trust that could evaporate without warning. When conditions were stable, this structure felt elegant. When uncertainty emerged, it became brittle. Interconnections deepened as traditional institutions relied on shadow channels for funding and risk management. Banks borrowed from funds they did not regulate. Funds invested in instruments backed by banks they did not supervise. Risk circulated through repurchase agreements, derivatives, and off-balance sheet vehicles that tied balance sheets together invisibly. Each link seemed manageable. Together, they formed a network few could fully map. Inside these markets, leverage accumulated quietly. Returns depended on small spreads amplified by borrowed money. As long as asset prices held steady, the strategy worked. Losses appeared unlikely. Models confirmed the logic. But the margin for error shrank with every added layer of leverage, even as confidence grew. Regulators observed fragments of this activity, but lacked a unified view. Oversight remained segmented, divided by jurisdiction and mandate. Each authority saw its piece of the puzzle, unaware of how tightly those pieces fit together. The system grew not only more complex, but more opaque, harder to monitor, harder to restrain, and harder to stabilize in a crisis. Markets rewarded this structure. Shadow intermediaries offered speed and flexibility unmatched by traditional banks. Investors chasing yield accepted unfamiliar risks, trusting that diversification and liquidity would protect them. Competition intensified, pushing participants further into structures they only partially understood. Success reinforced behavior. Stability bred complacency. For a time, the arrangement worked. Stress tests passed. Volatility remained low. Liquidity seemed abundant. The spotlight stayed fixed on visible institutions, while the shadows absorbed ever greater weight. Risk did not concentrate in one place. It spread across connections designed to function only in calm conditions. This was a hidden buildup, a system dependent on trust, speed, and continuous refinancing, without the buffers designed to endure disruption. It looked stable because it had not yet been tested. And when confidence finally wavered, the mechanisms that powered shadow markets would transform from strengths into accelerants. The question was no longer whether shadow markets mattered. It was how quickly they could transmit stress once the first link failed. The conflict surfaced the moment confidence began to slip. Not collapse, just hesitation. A fund declined to roll over short-term financing. A counterparty demanded more collateral. A routine transaction took longer than expected. Each action was small, rational, and defensible. Together, they triggered a chain reaction the shadow system was never built to absorb. Funding markets tightened almost instantly. Institutions that relied on daily refinancing discovered how fragile that assumption had been. When trust wavered, liquidity vanished. Assets that were considered safe could no longer be sold at predictable prices. Haircuts widened, margins were raised, and leverage, once invisible, became a crushing weight. Because shadow markets operate without traditional safety nets, there was no pause button, no deposit insurance, no lender of last resort standing clearly behind them. Participants moved first to protect themselves, accelerating the very stress they feared. What had functioned as a smooth, high-speed network now behaved like a tightly wound spring snapping under pressure. The shock spread through visible institutions with alarming speed. Banks dependent on shadow funding found themselves exposed overnight. Balance sheets weakened as off-balance sheet risks rushed back into view. Instruments once labeled low risk revealed embedded assumptions that no longer held. The boundary between the regulated system and the shadow system dissolved exactly when stability was needed most. Markets reacted violently. Prices disconnected from fundamentals. Assets moved in unison as investors rushed for the same exits. Correlation surged. Diversification failed. The structure that promised dispersion instead delivered concentration. Risk was everywhere at once, and no one could clearly see where it originated. Regulators struggled to respond. Their authority was built around institutions, not flows. They could stabilize banks, but shadow entities sat outside their direct reach. Interventions lagged the speed of deterioration. Each hour of uncertainty deepened losses and eroded trust further. The shadows, once invisible, now dominated the system's behavior. Public awareness arrived late, and without context. Headlines spoke of sudden freezes and unexplained volatility. The complexity of shadow markets made explanation difficult, and confusion fed fear. Confidence retreated not because people understood the system, but because they sensed it was breaking in places no one had been watching. The conflict was now clear. Shadow markets had delivered flexibility and growth, but without resilience. Their strength depended on calm. Their weakness emerged under stress. And once that stress appeared, it traveled faster and farther than any safeguard could contain. The system had reached its most dangerous moment. Not when something failed, but when everything tried to protect itself at the same time. The reckoning came when authorities were forced to acknowledge what had long remained implicit. Shadow markets were not peripheral. They were central. Their scale, speed, and interconnections meant that stabilizing only traditional banks was no longer enough. The crisis could not be contained by guarding the spotlight while the shadows unraveled underneath. Emergency measures followed. Liquidity facilities were expanded beyond their original boundaries. Central banks stepped into markets they had never intended to touch. Instruments once considered outside the safety net were suddenly supported to prevent cascading collapse. These actions were controversial, but they revealed a reality that could no longer be ignored. The system had evolved, and protection had to evolve with it. As conditions stabilized, reflection replaced urgency. Policymakers studied how risk had migrated rather than disappeared. They traced funding chains that spanned institutions, markets, and jurisdictions. The lesson was clear. Oversight focused only on visible entities leaves the system vulnerable to hidden concentration. Stability requires understanding functions, not labels. Reforms followed with a new emphasis. Transparency was expanded. Reporting requirements reached deeper into non-bank activity. Stress tests began to account for liquidity shocks beyond traditional balance sheets. The goal was not to eliminate shadow markets, but to reduce their ability to amplify stress unchecked. Flexibility remained valuable, but only when paired with resilience. For institutions, the crisis reshaped assumptions. Cheap, continuous funding was no longer treated as guaranteed. Leverage was reconsidered. Counterparty risk became a central concern rather than an abstract metric. The shadows did not disappear, but they became better illuminated, their influence more openly acknowledged. For the public, the episode exposed a hidden truth about modern finance. Stability does not depend solely on what is regulated, but on what is understood. Systems grow dangerous not because they operate quietly, but because their silence is mistaken for safety. Looking back, shadow markets revealed the cost of incomplete vision. They showed how innovation can outrun oversight, how efficiency can erode buffers, and how risk can concentrate in places designed to avoid attention. The lesson endures beyond any single crisis, because in a system where so much moves out of sight, the greatest danger is not what hides in the shadows, but believing the shadows do not matter.